the week. And this week, we're going to be focusing on the 10-year yield. It's not the bond, but it's the yield. It's the TNX. Let's take a look at this chart. As it appears, the yield is starting to roll over again. So much like we saw in the chart, if you take a look at the chart here, much like we saw back in October when we peaked, we came down and rolled under. And once we got under that 20-day moving average, which is this dotted line over here, the yields went tumbling down and the stock market went up. And more importantly, took small cap stocks up with it too. So here we are again with the yields having risen sharply from the start of the year. Actually, right at the end of 2023 was when we put in the bottom of our yield at about 3.9 or just under 3.9%. We rose all the way up to about 4.7. That seems to be the top for this cycle right now. And you can see that that line over there, right around 4.725 or 4.73. But we've come down sharply and we've crossed back down below that 20-day moving average here, right? And we've reached the bottom of the Bollinger Band. So that means that yields could probably bounce a little bit over here. We could get a bit of a move up there, back down over here, but it certainly seems to me that the downtrend is in place and we're going to be making lower numbers on the 10-year yield. And what does that mean? That means bonds are rallying, bond prices are going up, the TLT is moving up, which we've seen a sharp move up in the TLT from about the mid 80s up to about $90 it closed yesterday. Yields went down nicely yesterday, and the stock market rallied in kind. Actually, on Monday, the stock market rallied in kind with bond yields coming down. That is usually a positive for the markets when that happens. But getting back to the small caps, right? When interest rates are starting to come down, it means costs for small cap companies is also starting to decline. So borrowing costs, right? So what we've noticed quite often is when yields come down, you see money start piling into the small cap names, which is the IWM or the IWN, which is a value small cap index. The IWM is a small cap growth. And we see a lot of these stocks starting to outperform. And we saw that a little bit on Monday of this week. So I think that, if you take a look at the indicators as well, too, on the TNX, you see that full stochastics have rolled all the way down to an oversold rating. We have a MACD crossover here. And we are, again, approaching that. We landed actually right on that lower Bollinger Band, approaching the 50-day moving average and the 100-day moving average here as well too. So if we get a little bit of more of a drop in yield, about 4.3, I think we're probably going to turn back up in yields. And again, that may not be very positive for the market. It probably just means that the market is getting a little bit too anticipatory of rate cuts coming in later this year. So we know that as of last week, after the Fed meeting, the market is pretty much priced in about mostly one rate cut by the end of 2024. It's actually not even 100%. It's about 75, 80%. Some of that value has come back into a rate cut as of the last couple of days, especially after the jobs report came out pretty weak, weaker than expected on Friday, May 3rd. So we'll have to see what happens here with the yield, but I think as long as yields start coming down, it's going to be a positive for equities, and again, especially for small cap stocks. So that's the 10-year yield. Again, I think it probably's got some room to come down to about 4.3. It's about 4.459 right now. Down to about 4.3 would probably be a spot where I'd see it turn back up. We do have a bit of an uptrend in place, and again, this uptrend line comes down to about let's call it about 4.39 to 4.4. So if we come back down to hit that test line, we'll see what happens up there. But again, we could bounce right back up and come back down again, make a higher low in this chart, and then break down again. So there are some areas of support down here on the yield. We could come back down a little bit more, but I don't think it's going to be too dramatic here unless the Fed is really going to get aggressive on talking about rate cuts. Don't think that's going to happen later this year. So we're kind of stuck in this range. Let's call it 4.2 on the low end of the yield to about 4.7, 4.65 on the high end. That's the 10-year yield. Thanks very much for watching, everyone, and I'll see you guys.